Hi, can you hear me? Can you see the slides on the screen? If you can, just let me know.
Hello. Yeah, we can see, and you're audible.
I'm audible, no?
Yes, sir. Yes, sir.
Right. Okay. So good evening, everyone. We'll start the lesson for today. It will be about 2 hours. And after this class, there will be two more lessons on risk management. Then we've completed the theoretical aspects. So just give me a second. Screen seems to be a bit frozen. Just give me a second. Right. Okay. I think now it's better. Can see me. So today we will learn about a few internal control related frameworks. And for internal auditors, one of the most important frameworks is the internal control integrated framework by COSO. Internal control integrated framework, ICIF, right? Because this framework is put out by the Committee of Sponsoring Organizations of the Treadway Commission, right? Initially came out in 1992 and it was refreshed in 2013, right? In 2023, as one of the students very correctly mentioned in the class, they issued what you call supplemental guidance to achieve effective internal control over sustainability reporting, right? So in 2023, COSO issued supplemental guidance for organizations to achieve effective internal control over sustainability reporting. Because with the financial statements, an annual report of a company contains financial information as well as a lot of non-financial information, especially related to social activities, environmental activities. Some of it is qualitative, some of it is quantitative. So the importance of ensuring that these non-financial information, be it qualitative or non-qualitative, is accurate is very important. Sometimes when we do internal audits, one of the focus areas is to check the source of how these figures are reported on and the accuracy of these figures, the final uh, indicators, key performance indicators related to ESG. This is very, very important. So also in 2023 issued a supplemental guidance for organizations to achieve effective control over sustainability reporting. So the internal auditor's job is to one-way check the adequacy of internal controls related to financial reporting. So now the COSO framework also assists in helping organizations in terms of, ensuring effective controls over sustainability report, right? So that is something that I wanted to emphasize on, right? So when an organization wants to achieve effective internal controls, have a good internal control system, the standard that we recommend to them is the internal control integrated framework, which now, of course, includes ESG reporting as well, right? That came out in 2023. Right. Okay. Just give me a second. Now, if you look at the 2023 framework, the 2013 framework, it's quite somewhat similar to the 1992 framework, but a lot of changes were done, right? So if you look at the internal control framework issued by also, it defines internal control. Here, internal control is a process effected by an entity's board of directors, management, and other personnel. So it's not just limited to the board and the management, but even others can implement, any employee. It's designed to provide reasonable assurance regarding the achievement of objectives. Objectives, according to the COSO framework, are divided into three types of objectives. Objectives related to reporting, financial sustainability and all that. Objectives related to compliance. One of the key objectives of having controls is to ensure compliance, not only with laws and regulations, but with the internal SOPs as well, board directives. And internal controls, objectives related to operations. So we have operational objectives, reporting objectives, compliance objectives. All these three are important, right? But at a higher level, you have strategic objectives, strategic goals. But at the end of the day, all these things, when you drill down, they are either operational, reporting, or compliance, right? So internal controls is intended to achieve three classes of objectives. What are the three classes? Operations, reporting, and compliance, right? It's an ongoing process, right? It's not casting stone. Just because you implement internal control, that does not mean that you don't have to look at it again. It's an ongoing process. You have to continuously improve controls, always every year evaluate the effectiveness of internal controls. That must be done, and then continuously improve. When you talk about improving the effectiveness of internal control, what you're trying to do is to see whether it is effective at mitigating the risk, right? Mitigating the risk related to some objective. So internal control is affected by people at all levels of the organization, board, management, employees. Is able to provide only reasonable assurance. Right? Just because you have a control, that does not give a guarantee that 100% you will achieve operational, reporting, or compliance objectives. It gives only reasonable assurance, and then it's adaptable to an entity's structure, right? If you take a big organization and a small organization, the level of complexity or simplicity, the size, the cost-benefit analysis of internal control, all that differ, right? Some control that you put in a big organization, you can't put in a small organization, right? Then objectives. Appropriate objectives include financial performance, productivity, quality, innovation, customer satisfaction. So can you see, when you talk about operational objectives, you might wonder what. So operational objectives looks at performance also. This is not financial reporting. Reporting comes under separate, but performance. In any organization, you have KPIs. No, it could be sales, it could be profit, performance, right? So financial performance, financial KPIs, right? In terms of achieving it. Then you have productivity, efficiency related objectives, quality related objectives, innovation, and customer satisfaction. So these are some of the things that you have to remember, because at the exam you might be asked productivity is related to which class of objectives. So operations, productivity, innovation, customer satisfaction, financial. So they're all related. Operational, financial performance. Operations objectives also include safeguarding of assets. Obviously, safeguarding of assets, right? Protecting, preserving assets, right? All that is important. Avoiding waste, inefficiency, and bad business decisions. That has something to do with productivity also, how you produce more at less cost, less inputs, right? So inefficiency, waste management, all that is related to operations. Reporting, of course, as you know, reporting is about financial and non-financial information. So now financial, near sustainability information, right? It's about the timeliness. You can't take years and years to report your figures. Timeliness, how quick if reports are generated through Excel or something like that, we have to talk about that. If it takes 3 days to prepare a report, then it's very inefficient process. So timeliness is important. How long does it take to prepare the report? How is it prepared? Reliability. Is it done on Excel? Is it manual? Is it through a system? System-based reports are generally more reliable. And timeliness and transparent financial information. Transparency means you need to know how that figure was reported, from where was it picked up. The transparency must be there in the financial reporting process. Any figure on the balance sheet, income statement, or KPIs, you must know how it came there. What is the process? There must be transparency in that. So when you talk about reporting objectives, you have 3 elements: the timeliness, the accuracy or reliability, and the transparency. So you have internal reporting to the board and all that, or to departmental heads. Then you have external reporting to shareholders, regulators, and all that. Reporting also can be financial and non-financial, right? So I'm going a little fast here. Compliance objectives means compliance to rules, regulations. I mean, when we are doing internal audits, internal controls are there to ensure that the operations, and even the reporting, right, meets compliance objectives. So compliance regulations can stem from, some act passed in parliament, it can be a regulator issuing, it can be the board of directors issuing certain board decisions, can be even the internal policies, procedures, SOPs, right? So it's very important that you think of, you understand these three ORC, right? Three types of operations. I hope that is clear. And we go on quickly. Achievement of our objectives. And internal, if you have an internal control system, right, you are more likely to achieve your objectives, right? That's something that is more likely to provide reasonable achieving of the reporting and compliance objectives. Yes, then operational. Operational is operations. When you have compliance and reporting, internal controls are provide great assurance. But when it comes to operations, there are so many external factors, which sometimes your internal control may not properly address. It can be foreign exchange fluctuations, interest rate fluctuations, your the legal system, the political environment. So in terms of achieving compliance and reporting, it's a little easier through internal controls than achieving operational objectives, right? The other point, I'm just only going through the key factors. Then if you look at the course of framework, one aspect of it is these objectives. So three types there that you know. And then they talk about these components. Components. So what are the components in the course of framework? That you have to know, the components, right? So I will quickly share a small document with you. Hold on. Right. Hope you can see it on the screen. Ananja, you can switch off your camera if you like. So you have here, you have Adi, the risk management framework. You get the internal control framework. So, give a second. Yeah, operations, reporting, and compliance. I hope you can see it. So these are the objectives. Then you have these components. So there are 5 components: control environment, risk assessment, control activities, information communication, and monitoring. These are the 5 components. In any internal control system, you have to address all 5, right? You must look at the control environment, risk assessment, control activities, information, and monitoring activities. Then inside all these, right, inside all these, you have this. Can you see the screen on this? Can you see it? This table? Someone can quickly confirm. Again, can you confirm? Can you see this table on the screen?
Yes, sir, we can see.
Right. So the course of framework has 3 objectives, 5 components, and 17 principles. These are the 17 principles divided across those 5 components. Under control environment, what are the principles? Demonstrate commitment to integrity and ethical values. So what they are saying is, in the control environment, if the board or the management, they should demonstrate commitment to integrity and ethical values. This has to be communicated. That means there must be a right tone at the top. They must exercise, the board audit committees must exercise oversight responsibility. They don't exercise the oversight responsibility. If there is no audit committee, if there is no nominations, HR, remuneration, RPT review committee, then problem. The board has a responsibility to exercise oversight over the management and over the governance of the entity. So they must exercise their oversight responsibility effectively. And also another important area of the control environment is establishes structure, authority, and responsibility. That is about having a proper organizational structure, proper divisions, functions, as well as the delegated authority limits, right, to each level of management, who is reporting to whom. And also you need to have your job descriptions and SOPs in place, right? Because that will help also with point number 5 in terms of ensuring or enforcing accountability. Sometimes in companies, you can't enforce accountability. If something goes wrong, you can't pin the blame on one person, right? Because or many persons, because it's not properly defined. responsibilities are not properly allocated. It is not documented. And you have to demonstrate commitment to competence. This also we looked at last time. Can you remember? We said the right people need to be hired, right people need to be brought into the organization. So the performance appraisals must be done properly. Training policies must be carried out. Training needs analysis and all that needs to be there. So this control environment, you can have the best controls in place. But if the board of directors does not, or the management CEO heads of division does not, what you call, exhibit or display the proper values, they don't embody or espouse the proper values, or that commitment to integrity is not there. They don't maintain the highest levels of standards of integrity or ethics. If there is no code of ethics, no code of business, there is a problem. Then if they do not exercise their oversight responsibility, when you go to the minutes of the audit committee and other committees, what they discuss, what they get reports on quarterly basis or monthly basis, and how do they exercise their responsibility, that you must see. For example, every year the audit committee must ask the management, how do you all manage the risk of fraud? Do you all do fraud risk assessments? When was the last fraud risk assessment carried out? Have you mapped the controls to those fraud risks that you identified? Have the internal auditors gone through those controls? What sort of assurance can you give us? And then how is the code of ethics communicated? How is it made aware of? When do you enforce it? So those sort of questions, especially what are the internal controls in the financial reporting process? Have you tested those? Can we see that report? So those sort of questions the audit committee needs to ask. If they don't ask those sort of questions, that could mean that they are not exercising adequate oversight over fraud risk management, over the financial reporting processes. That's very important. When you look at the organizational structures, the delegation of powers, authorities, the JDs, the job descriptions, all that is important. When you look at their commitment to competence, they have the wrong people. Are they competent? Sometimes you go to IT departments, they are not properly competent enough to carry out their responsibilities given the ever-evolving cybersecurity landscape of the country, of the world, right? Enforcing accountability. So when things go wrong, would they carry out investigations? Would they enforce accountability? Who has been disciplined? What ethics issues have surfaced or materialized during the year? Those sort of things you have to see. You're doing internal audit. It's not just these control activities. Can you see the third column? It's not just that. It's actually something you have to look at. Right? You have the time. Then you have the risk assessment step, which is the second one. This is about setting objectives for the organization, which is usually done by the board and the management. Then risk assessment. What are the risks that are there which would prevent the company from achieving those objectives? And fraud risk assessment. Can you see assess the fraud risk? And then identify and analyze significant change. Have there about what changes have taken place in the external environment, legal, political, economic, social, technological environments could affect the organization. So that risk assessment is very important. Now, this is not something that you have to do as an internal auditor. Management should do it. If you look at leading companies in Sri Lanka, banks, have they done this? Have they done risk assessments? You have, when you go to do an internal audit, there sort of document that you can see. Mainly, they do this at a very macro level. But now see, number 8 says fraud risk. Fraud risk is something that is assessed at process level. No? Asset misappropriation risks, financial statement fraud risks, bribery and corruption risks. See. Then you come to the control activities. This is about having the proper internal controls in place, these proper policies, procedures, and then selects and develops general controls over technology. Can you see? When they look at control activity, they are saying proper IT-related controls are also important. General controls. Can you see? General controls over technology. It's called ITGC, IT Information Technology General Controls. Right? So that aspect, we discussed it last time, if I'm mistaken. So the general controls of IT. It's integrated, not application level, but IT general controls. And then you have deploys through policies and procedures. Controls are generally deployed through policies and procedures. So some organizations do not have, as for their policies, procedures, they give their ISO flowcharts. ISO flowcharts don't actually look at internal controls. That's for something, some other purpose. That's for documenting a process. And an internal control also you can do flowchart, but you have to document the control. Which is the most important thing. Then you have the fourth pillar, information and communication. Right. So when you look at all your policies, when you look at all your procedures, when you look at your code of ethics, right? They have to be communicated. No? Can't just have to look at your JDs. All that has to be communicated. So that is one aspect of communication. Communication of policies, procedures, and training. And some of the policies have to be communicated to external people. Your code of ethics, your anti-bribery corruption policies have to be communicated, whistleblowing policy have to be communicated to those who are external to the organization. So that is one aspect. Policy, procedure, communication internally and externally. The other aspect of this is in any internal control system, you have KPIs, you have key performance indicators, you have KRIs, key risk indicators, and there are ways within departments, right, to monitor effectiveness of internal control. That has to be done not only by the internal auditor. Internal auditor comes once a year, maybe. Or they may audit a specific area once a year, though they may be there throughout the year, auditing various functions and departments. But the department itself must have its own monitoring mechanisms to see whether things are happening. It can be through reports, it can be through exception reports, it can be through forest pin alerts. They have to have. It's called level 2, L1 controls, the department itself, right? Level 1, internal audit is in level 3, compliance risk is in level 2. So L1 controls must be there, departmental level. And for that, they need to get relevant quality information, right? So you can see, it can be the preparation of a bank reconciliation. Has it been done? Is it being checked? So to do that, to see whether it has been done and checked, the departmental head will have to have his own reporting mechanisms. That has to be there. And those internal monitoring mechanisms are very, very, right? Now, the fifth column is about how the internal auditor comes in and does his monitoring, and right? So that is a little separate. The fourth column on information and communication is about, internally ensuring how internal controls are communicated, importance of it, how violations are communicated, parameters are set, and all that. Monitoring activities generally involve doing internal audits, for example, and then taking remedial action, improving controls, taking action when there are violations, non-compliances, and all that, right? It can be ongoing, it can be separate even. Ongoing means departmental level evaluations. Separate means usually the internal auditor comes and does, and you can have real-time monitoring also, right? If you go down here, can you see demonstrating an effective ethics program? Common implementation challenges, lack of a formal ongoing ethics program, lack oversight of the ethics program by the audit committee, neglect to review the code of conduct, see inadequate reinforcement by top and middle management, means they are not focusing, the tone is not right, not communicate expectations of integrity and ethical values to parties and outsourced service providers, have inadequate ongoing training programs on ethics, including financial reporting. So there are loads and loads of challenges, which actually we don't need to go through in detail, but it's good for you to know. So this we already discussed, setting tone at the top about integrity and ethical values, the control environment, setting the tone at the top, establishing standards of conduct, evaluating performance of individuals and teams based on established standards of conduct, and then correcting deviations, right? So I think we can read this up, and figure it out. You have, give me a second. The board demonstrates control environment. The board demonstrates independence from management. That's very important. The board and the management cannot be the same. Board has to be independent, right? So the board has to be independent, and then they have to establish oversight. This is very important. Operate independent. Have an audit committee. Can you see another committees? Provide the board is responsible for oversight. You see the word oversight? That means oversight of management's design, implementation of conduct. So management designs internal controls. Management implements internal controls, right? Management implements means conducts internal controls. But the board is responsible for oversight, right? Board is responsible for oversight of management's design, implementation, and control. So this is a nice way to remember it. Oversight, management's design, implementation, and conduct of internal control. Structures, the organized structures, reporting lines. Here to see appropriate authorities and responsibilities. Those things have to be carried out properly. Nature of the business. Of course, what they are saying is when you consider the structure of the entity, the reporting lines, look at the nature, size, geographic distribution, reporting requirements, and all that. You have to study the entity first, industry within which it operates, look at the size and complexity, product services it offers, geographic distribution, all that, and then decided what should be the most appropriate structure. Establishes and evaluates reporting lines, right? What are the reports sent to the board, audit committees, reports sent to divisional heads, all that here to see. Design, assigns, and limits authorities and responsibilities. That's about the delegated authority limits. Authority limits are delegated down the hierarchy, and you have to see whether the delegation of this authority is not too excessive. Too excessive. If it's excessive, delegation of authority also must not violate segregation of duties. Right? SOD checks have to be done. Then the extent to which activities are delegated, just because something is delegated does not mean that you don't, you're not responsible for that. You're responsible. Responsibility can never be delegated. I mean, you can delegate certain amount of responsibility, but the head of the department ultimately, in overall terms, responsible. But the extent to which certain activities are delegated, you have to check and give some sort of opinion on that. The organization must commit, attract, can you see, recruitment policies, develop, training, and retain. Retention is done through having proper promotion policies, performance appraisals, increments, bonuses, variable pay, all that is right. And then the succession plan, right? What are the key positions? Have they identified successors? Sometimes they don't have proper succession within the organization. That's fine, but at least when somebody leaves, there must be someone to act until a permanent person is recruited from outside. Organization holds individuals accountable for their internal control responsibility. Right? Can you read these 5 points? How do you hold? We are looking at everything from a internal control perspective, right? So how do you hold people responsible or accountable for their internal control responsibilities? Internal control responsibilities. That is through this. Can you just read it up? Responsibilities, how you hold people accountable is through structures, authorities, responsibilities. Establish performance measures. Yeah, how to monitor the performance of people. You have to give, you can't, how you can hold someone accountable, you have to measure, no? You have to measure, monitor. It should be quantitative as much as possible, and then their variable pays, rewards, incentives can be based on performance. No? So the setting of KPIs is very, very important. And no point setting if you don't actually monitor the actual. Evaluate performance. So establishing KPIs, monitor performance against KPIs is very important, and consider excessive pressures. If you look at the fraud triangle, one of the causal factors of fraud in an organization is pressure or motivation. So if you incentivize people to commit frauds by giving them excessive bonuses, if their pay is more related to achievement of unreasonable targets, unreasonable KPIs, then by hook or crook, they will try to somehow achieve those targets, right? The variable pay, sometimes if you say, okay, you achieve 100 million bonus if you achieve 5 billion profits, and the 5 billion is not very, and the 100 million bonus, but the salary is only 7 lakhs or 1.5 or 2 million. Then the bonus, the way the remuneration is structured, incentivizes that person to somehow, by hook or crook, achieve that target. So fictitious invoices may be put. So you have to consider the balance for variable, what you call fixed and variable pay. Excessive pressures must not be there. Targets must not be excessive. The targets are excessive, only they will try to do something to achieve those targets. Evaluate performance and reward or discipline individuals. That is understood. You know, performance appraisal structures must be there. And based on that, decide on your bonuses and increments. Risk assessment, we said you have operational objectives, you have financial reporting, external financial reporting. The financial, then you have external non-financial reporting. Right, in your annual reports, if you look at the information, you can be financial and non-financial. You can have internal and external. Then compliance related objectives also there. So these three are financial objectives. No? Right? Apart from that, you have operations and compliance. The organization identifies risks to the achievement of these objectives. Right? So risks in achieving these objectives. That's what is important. Across the entity. Across the entity. It's not just specific to one department, all functions. And analyze the risks, see how the risks could be managed. Then management must focus carefully on risks at all levels. When you talk about risk, everything is risk-based. Once you do your risk assessment, you identify what the high and medium risks are, and then pay more attention in terms of mitigating those risks. Right? The organization considers the potential for fraud in assessing fraud risks. So can you see? When they say assess risks, in the next slide, they say assess fraud risks. These are very important risks, IT risks and fraud risks in achievement of objectives. At the end of the day, as an internal auditor, there are so many risks, but we are mainly concerned with GRC, governance risks, risk management and controls. We are looking at GRC, governance, risk management and controls. So under the risk management pillar, the risks we have to consider, right? So obviously there will be operational risks, financial risks, and compliance risks. There are three types of objectives. Obviously there will be on the other side, you will have three types of risks also. So under operational risks, you have fraud risks. Fraud risk is the risk of fraud. Operational risk is the risk that arises due to processes, systems, and people, right? Due to human risks, due to system-based, so that covers IT, and then process-related risks. So across all three, you can have frauds, right? Now, when you're considering the risk of fraud also, you have to consider the risk, the types of fraud, right? So you have asset misappropriation frauds, then you have bribery and corruption frauds, then you have financial statement frauds. So and then you look at the fraud triangle also. Are there any factors which pressurize the people to commit fraud? Are there any factors which give an opportunity to people in the organization to commit fraud? So one can be weak internal controls, give an opportunity. Lack of segregation of duties can give an opportunity. Something like that. Having unrealistic goals, targets can give an incentive to commit fraud. You don't have What are the other pressures? Living beyond your means, having addictions, people having addictions can give rise to. They can be pressured due to financial difficulties in terms of committing fraud. Rationalizations. Are there any uh, factors which could give these staff members or employees some sort of justification to commit a fraud? It could be family, a spouse losing their job. It could be staff being underpaid. So they feel if I steal, it's okay. It could be the company is not doing well and they need to kind of get a bank loan, and for that you have to commit financial statement fraud. You might think the person committing it might think, no, I'm not doing it for myself, I'm doing it for the company. They can rationalize. So any sort of sicknesses in the family where they feel that if they're underpaid compared to market rates, they might feel, no, we are entitled to this money, so stealing it is okay. So this is also another aspect, another dimension of fraud, where they say, don't just look at the types of frauds that could occur, just see whether there are any what you call pressures, opportunities, or reasons as to why they can justify a fraud. Be vigilant to that also. So at the end of the day, for a fraud to occur, those factors also need to be present, no? Pressure, opportunity, and rationalization. The organization identifies and assesses changes. Changes to the external environment, changes in the business model, changes in leadership. Can you see? These can have a change. I mean, you from a bad leader to a good leader, from a good leader to a bad leader. Right? That can affect the control environment, the business model, changes in the external environment. You think of pest, political, economic, social, technological changes, or legal, pestle. You have E, environmental and legal changes. So all that you can think of, because all those will have an impact on maybe your operational risks. It can have an impact on your compliance risks. It can also have an impact on your financial reporting risks. Having policies and procedures, they are very, very important, right? The organization under control activities. Can you see the third pillar? The organization selects and develops control activities. Yeah. So controls must be put in place to address a risk, right? That is important to mitigate a risk. Organization selects and develops general control activities over technology. That is GITC. That is also important. General controls over information technology. You can do a GITC also. Then control activities are established through policies, right? And then procedures. Information systems, information and communication, the fourth pillar in an internal control system. Information systems enable organizations to obtain, generate, use, communicate information to maintain accountability, measure performance, review performance. Three principles relate to this. The organization obtains or generates and uses relevant quality information to support the functioning of internal control. So here, what they are saying is in an organization, to properly manage the organization, to properly control, you must know that your internal controls are functioning properly. So relevant and quality information to support the functioning of internal controls, right? Not everything. Huh? The functioning of internal controls, that's the key word here, right? The functioning of internal control, right? Because now there are internal controls in an organization. So how do you know whether the internal controls are working or not, right? So one is that the organization internally communicates information, including objectives. Now, if there is an internal control, that internal control is related to an objective, right? It's related to a risk, no? So have you communicated to the people, you see, these are the objectives, these are the risks, these are the controls, and this is the control you are going to perform, right? You are responsible for this control. You can't just still perform this control. This is the objective, this is the risk, this is the control. This is why you're doing it. And this is your responsibility. Have you done that? The organization communicates external people regarding matters affecting the functioning of internal controls. Now, ethics, code of ethics also is a part of internal control. Have you communicated the code of ethics, anti-bribery policies? So there are internal people as well as external parties. External parties are now third-party vendors. There's so many third-party vendors now, no, as part of the supply chain. So they also have to ensure that if you're subcontracting the manufacturing to some manufacturer in Sri Lanka, a US company. So the Sri Lankan company also has to ensure that internal controls are properly functioning. Labor, underage labor, health and safety issues, all that. So for that, you have to have controls. For that, you have to communicate your policies, procedures, and everything to those third parties. Data protection, which can sharing of personal data. Now, in Sri Lanka, we have a Personal Data Protection Act, effective from March next year. So all that has to be communicated, right? And then once everything is internally communicated, externally communicated, then we have to have a way of obtaining relevant quality information to support the functioning of internal. When you say support the functioning of internal controls, how do you support the functioning of internal? One is to document all these controls. Another one is to properly communicate all these controls. So it's basically policies, communication, awareness, implementation of policies, procedures, code of ethics, job descriptions, and all that. And then you can have other internal control related KPIs and KRIs also coming in, right? And then communication of responsibilities, accounting, monitoring, control systems and the way controls are applied change over. Monitoring is the process that assists the quality of internal control performance. So what they are saying here is, just because you implement internal control today, that doesn't mean that in 6 months down the line, it is still effective at mitigating a risk. You have to monitor the effectiveness of the control, quality of the control. So you have to have some process of evaluating it to see whether it's still effective and when it's functioning as required, right? So you have to have some sort of, way of identifying the deficiencies. Here, the organization evaluates and control deficiencies. We have to tweak or modify the internal control, right? Control baseline means the basic design, an understanding of the internal control design and whether the controls have been implemented in an effective way to accomplishing the objectives, means mitigating the risk. So we have to understand it. That is whenever we are reviewing the effectiveness of internal controls and trying to see whether the internal control has to be changed, modified, improved, or whether it's irrelevant. We have to understand the control baseline. How was it designed? What was it? How is it designed? What is the risk it is mitigating? What is that risk? What is the objective related to that risk? To understand. Objective. Change identification. This is also important as well, because to see whether the control is effective or not, you have to see what changes have taken place. The environment, that I mentioned earlier, risks can change. No? When risks change, then there is a change management element. A new control baseline for modified controls. And using monitoring procedure to confirm the conclusion that the controls are effective. Continuous monitoring. So this is all about, once you go here, you understand the control baseline, what it's doing now. Then if there is a change, ongoing or separate evaluations are used to identify whether changes in process or risks are being addressed. The process could have changed. Now you're doing it in another way. The way you're raising purchase orders has changed. Earlier it was manual, now it's automated. Now the process has changed. The risks have changed. In the same way, the objectives may have changed. Right here, the organization should confirm that controls continue to meet the objectives. So the process itself can change. You may do it in a different way. The risks can change. The objectives also can change. So if there is any change, identify that change in the process. change in the objectives, changes in risks, right? All has to be looked at. And then you manage the change. You have to see whether the control is still meeting those changes, right? And then you have to establish a new control baseline, a control base, and then control validation is to see whether it actually is effective. So for that, you might need some time. Some controls, when they're implemented, if it's a system-based control or something like that, can be implemented immediately. Then you can check it. If it's a process-related control. Some controls, you may have to wait a little bit of time. So this is that model here. We already discussed this. Then we move on to the COCO model. The COCO model, right? So COCO model is also a very interesting model, right? And was introduced by the Canadian Institute of Chartered Accountants. Canadian Institute of Chartered Accountants, right? So that model also you have to be a little familiar with. Because it is a internal control framework. So going into the details of this, but you have to have some idea about this model. Okay? So can you see the screen? What it is? It has 4 components. So from here, COCO, what does COCO stand for? That you have to know. Criteria of control. Criteria of control. Who introduced it? Canadian Institute of Chartered Accountants. How many components has it got? COSO had 5 components. COCO has 4. COCO has 4 components, right? 4. COSO had 5. Then it consists of 20 criteria. Consists of 20 criteria. In COSO, you had 17 principles. 5 components, 17 principles. In COCO, you have 4 components, 20 criteria. What are the 4 components? Purpose, commitment, capability, monitoring, and learning. Purpose, commitment, capability, monitoring, and learning. Right? How you remember, there's an acronym also for it. So what you have to kind of remember here is what is the COCO includes within the scope. Of course, I don't need to tell you this. I just try to see what is important for you to remember. Otherwise, no point learning all these things also if it's not really relevant to you. Just give me a second. Just give me a second. Give me a second. I will send you a small note on the COCO model. Right now based on this slide, says it has four components. No, so under these components there are certain criteria. Right? When you say purpose, why are internal controls there? Right? When you look at commitment, it's like in the control environment, you have the proper tone at the top and support of the senior management. If you look at capability, that means you have the right people at the right places, and you have terms of human resources as well as technology to support internal controls. And when you look at monitoring and learning, that's similar to monitoring in the COSO framework, right? So it overlaps with the COSO model also to a certain extent. If you look at the COSO model, you had control environment, risk assessment, control activities, IC and monitoring. So some of those are coming in these areas, right? So what I will do is I had a nice note for this. I don't want to explain too much also the COCO model but my fear is that I can remember once there was a question on COCO and they asked what component does what they were talking about belong. For example, they said the company lacks uh, lacks uh, the support of the senior management, then it falls under the commitment component. Or they don't have the right people or the technology support in it, that comes under capability. So like that, they could ask you some sort of question and say under what component would that be addressed. So for you to do that, you might have to know a little bit more than what is on the slides. Because you have to map it to the right one. So just locate that. I can't find the document where I saved it. No, I can't locate that document. I will locate it. Just a one-page document. We just go through that, and that would be sufficient for you to understand this entire framework. Right. So we will move to the next slide on COVID. So when it comes to technology, can you remember we learned about ITGC, information technology, general controls. So therefore that the best framework is COVID. What does COVID stand for? You will have to know. Control objectives related to information technology. So it's the best known control and governance framework that addresses IT. So like COSO for internal controls for IT, this is the foundation framework. All other ISO 27000, ITIL framework, all those are built on this framework, with the foundation framework, right? So it's the best known control and governance framework that addresses IT. In its original version, COBIT was focused on controls of specific IT processes. Over the years, IT has gradually come to pervade every facet of the organization. Earlier, when it came out, these controls were limited to the IT department, but now it's all pervasive. It spans across all functions and departments, right? It's no longer just limited to the IT department. So here again, there are a few slides, principles. If you look at this principle 1, COVID 5 has 5 key principles. Meeting stakeholder needs is one, covering the enterprise end to end, right? Applying a single integrated framework, enabling a holistic approach. When you're separating governance from management. So those 5 principles are very, very important. Then they talk about the conversion of COVID 5 to COVID 19, a few changes that occurred. And then they have this maturity level framework also. When you come to Well IT and the ISAC model, some of which you can read at leisure. So let's go to the first COVID 5 asserts that value creation is the most basic stakeholder need. So in an organization, you have different stakeholders, shareholders being one. You have the community, you have staff, employees, you have suppliers, you have management, you have shareholders, you have various stakeholders, multi-stakeholders. And you have to, at the end of the day, create value for these stakeholders. Right? You have to create value. The creation of stakeholder value is the fundamental goal of any enterprise, commercial or not. The COVID framework kind of recognizes that an organization has multiple framework, multiple stakeholders, and it is important to identify the needs of all these stakeholders, identify the needs. That's why if you go through an annual report of an organization, right, of a good or multinational, you will see they have a few pages on engaging stakeholders, how they have carried out a stakeholder needs analysis or interest analysis. What are their interests? And they map it into 4 quadrants, right? And identify what they are, what interests they have. And then the activities of the organization must ensure that most important key interests of key stakeholders are met. So what they are saying here is value creation is recognized. Stakeholder needs are recognized in COVID 5, right? Value creation in this model is achieved by balancing 3 components. How do you create value for a shareholder? How do you create value for employees? You have to realize benefits. Realization of benefits. They are looking for certain benefits, you have to give it to them. Second one is optimization of risk, not minimization. So what they are saying is risk has an upside as well as a downside. The greater the risk you are willing to accept, the greater the reward. So just because there is risk, it's not about minimization. It's about sometimes taking the risk and controlling it. So just remember that risk management is not just about minimizing the risk. It's about optimization of risk. That is, the risk, without taking risks, you can't have rewards, right? You have to take some sort of a risk. There is an upside to risk, an opportunity as well as a downside. So it's optimizing this trade-off that is important. The best use of resources. So efficient use of resources, optimizing risk, and realizing benefits. You can do these 3. Realizing benefit means achieving the goals, achieving the targets. So this is how you create value. I can remember there's an MCQ also on this. What does it mean for an organization to create value? So it is optimizing risk, optimal use of resources, and realizing benefits. Just remember that. And this model recognizes this. Can you see? What drives the stakeholders? What are their needs? Then you have to think about meeting those needs. Then you have enterprise goals. Then IT related goals, enablers. So what I want to tell you here is that when Now we are looking at IT general controls. Now we are only looking at IT control. But these IT controls, right, are related to IT goals, IT objectives. IT objectives must enable enterprise objectives. So in this model, the organization looks at their stakeholders and identifies the stakeholders. It identifies their interests. To identify interests, you have to talk to these stakeholders and ask what are your interests in the organization? What do you want to get from the organization? So you have what you call a stakeholder engagement assessment or analysis that needs to be done, which involves like a fraud risk assessment, identifying frauds and evaluating frauds. Here you identify your stakeholders and you identify what their needs are. So meet those needs, of course, you have to create value, and then you have to think about those three aspects which we discussed earlier, and then the organization will set enterprise goals in such a way where the key interests of the key stakeholders are met. Now, from the organization or enterprise goals only, you will derive your IT goals. You will derive your IT goals. So this is what you have to remember. Right? So in COBIT 5, there are 70 enterprise goals. COBIT 5 supplies 17 generic enterprise goals. So then from those goals, you have your IT related goals, 17 enterprise goals, and from those, you have your IT related goals. That is what you have to remember. So if you go to the internet and type Orbit framework, right? All these goals, enterprise level goals are there. Now, they don't expect you to go through all this. But you will have to know what these main ones are, right? What these main ones are. So can you now just read this slide again? Can you go through what's on this slide? Let's move to the next slide. Ken, can you read this, please? I will share with you a small thing. Can you look at this document? Right? These are the 5 principles. This will be easier for you to see. Meeting stakeholder needs. This COBIT model covers the enterprise end to end. That means it covers all functions at all levels. It's a single integrated framework. It enables a holistic approach. And it says that IT governance must be separated from IT management. So the IT governance aspects, responsibilities are given to the board. IT management is given to the IT departments, right? Enabling a whole. So these are the 5 principles. So at the exam, you might be asked these 5 principles. So you don't know this. I hope you can see the diagram which I'm sharing on the screen. Okay. Then you have the COBIT 5 enablers. These are the enablers. There are 5 enablers, right? These are the enablers. 1, 2, 3, 4, 5, 6, 7. 7 enablers. I hope you can see it. Principles, that means what they are saying here is if you want to implement proper IT controls, you have to have proper IT principles, policies, and frameworks. Framework means using ISO or using COBIT, or you have to implement some framework. When you think of IT governance, you can't just say have policies and procedures. No. When you're implementing internal controls, you have the COSO frame. Similarly, if you're implementing internal controls in IT side, on IT governance, you have to implement some framework. So you can have the ISO framework. So the IT governance framework now for ISO, I think it's 38500. Then you have ISO 27000 related various standards. Then you have the COBIT. So you have to have principles related to IT. You have to have IT security policies. You have to adopt a framework. COBIT is one of them. Then you have to have various processes. Can you see? Lot of processes we'll discuss later. Then you have to have proper organizational structure. Then you have to look at the culture, ethics, and behavior side. Can you see? Have a proper culture, ethics, behavior. Then information, like information and communication in the course. Then when you look at ITs, you have IT related services, you have IT infrastructure, the hardware aspects, and the IT applications, the business apps. Then you have the people skills and competencies. Without these, you can't have proper IT governance in an organization. COBIT is a very important IT governance framework. Remember that. So for that, you need principles, policies, frameworks. You have to adopt some sort of framework. You have to have processes. You have to have proper structure. You have to have a proper culture. You have to have information. Then you have to select the proper hardware, software, and the services, because some services will be like cloud services will be outsourced and contracted. Then you will also have to have people skills and competencies, right? Now, this is the other structure. Can you see? Now, look at this. Now, one of them, one enabler is processors. Can you see? Here. Processors. That is point number 2. If you go into processors, these are the processes that you need to have. That is divided. All the processes are divided into align, plan, organize is 1. Build, acquire, implement. You build applications or you acquire applications or you implement. Then deliver service support. So it's more the service side. And monitor, evaluate, and assess. So these processes, if you check how many processes do you have here? 1, 2, you can count and see, yeah? Yeah, outside also you have a few processes. I think there might be 40 processes. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31, 32, 33, 34, 35, 36, 37. About 37 processes you have, right? So all these processes you must have. Let's look at one. Manage the IT management framework. Manage strategy. Manage enterprise architecture. Manage innovation. Manage portfolio. Manage budget and costs. manage human resources. So all these aspects need to be covered, right? So these processes also governance days go up. COVID 5 process reference model subdivides IT related practices and activities into two, governance and management. So there are some processes related to governance. There are some processes related to management. The governance domains contains 5 governance processes. Within each process. Within each process, evaluate, direct, and monitor practices are defined. 5 governance processes are there. Yeah, at the top here, these are governance ones. The top 1, 2, 3, 4, and 5. Then there are 4 management. The management ones are given in blue, divided into 4. Right? Can you see? The governance processes are evaluate, direct, and monitor. Ensure governance framework. Right? That means you have a framework. Ensure benefits to delivery, ensure risk optimization, ensure resource optimization, ensure stakeholder transparency. Those are the governance parts. So you don't have to know all that, but just remember the 5 principles, the 7 enablers. 7 enablers you have to know. Principles, processes, structure, culture, information, then the actual portfolio, hardware, software applications, and the services, and the people skills and competencies. You have the wrong IT people, unskilled, incompetent people, you've had it. If you selected the wrong service, IT services to outsource, wrong service providers, wrong hardware, wrong applications, you're screwed. If you don't have proper policies, frameworks, you're finished. If you don't have the proper culture, proper structures, or proper processes. On the processes side, you go down the process side, they have defined it nicely. Processes for governance. The top 5 are governance. So governance, there are 5 processes. 1, 2, 3, 4, 5. The others come under management processes. So from a board of directors, which is responsible for governance, they have to ensure that the governance framework is adopted by the management. It could be COVID. The board must ensure that stakeholder needs are identified and benefits are delivered to the stakeholders, oversight. The board is responsible for risk optimization, resource allocation, resource optimization, and stakeholder transparency. These are governance, that is the board's responsibility. Some boards now today have a IT governance committee, or they have the audit committee takes over this responsibility. They may have a separate IT governance or IT security committee. And the management is responsible for all those in blue, the boxes in blue, right? So if you like, you can just go through this a little more. Then I'll share this note with you. Organizational structures, every organization needs the right structure to be effective. True organization structures have clear operating principles in place that set out the day-to-day workings, right? COBIT uses organization structure as a way of enabling organizations to map out the most effective strategies for escalations within the environment. Culture, ethics, behavior, the right culture, the right behaviors, information, right? For an IT department also, you need, of any department which manages IT, they have to get the information that they require. Services is the portfolio architecture, right? At the end of the day, it's all about hardware, services, and business application software. And the people, IT is all about people, right? Then you have the governance pillar. Can you see? Governance means to evaluate, to evaluate, to monitor, EDM. Management is about planning, building, running, and monitoring. Right? If we go up here, first one is planning, second one is building, third one is monitoring, and you have deliver services also, right? I will share all this. DSS services, and then EDM, Board's responsible. The governance aspects the board has to do. Evaluate, direct, and monitor. Right? Can you see this? And then you have the plan, build, run, monitor. Those are the responsibilities of the management. Now you will also need to know a little bit about, I will share the other one now. To go back, covering end to end. COBIT 5 takes a comprehensive view of all of the enterprise's functions and processes. Now, one principle of this COBIT is it takes into account the stakeholders, multiple stakeholders' needs and ensures that value is driven to them. Through this cascade approach, because to look at the enablers and the IT related goals, it starts with the stakeholder stakeholder needs, strategic or enterprise level goals, and from the enterprise goals only the IT related goals are cascaded. And then once IT level goals are cascaded only, you identify the enablers, right? Now, so meeting stakeholder needs is that covering into enterprise end-to-end means if you use COBIT model, it covers all the processes and functions in an organization. It's not just limited to one function or department. So IT governance is integrated with enterprise governance or corporate governance. So if we have a difficulty telling you that the COBIT model ensures that the entire enterprise is covered from end to end, covering all function process, then it comes under principle 2. Now, the other benefit of COBIT is that it's one single framework. It's one single framework. It's an overarching framework. Right? It's not related to one industry or one specific function, or it's not related to any specific hardware or software. It's independent of all that. It's independent of industry. It is independent of hardware, independent of software. It's independent of other standards. So COBIT is ideal that way. It's one single integrated framework, right? And on top of this framework, you can implement your ISOs and ITILs and all other frameworks. You have to remember that. It's an overarching framework. It's like COSO for internal audits. That's why it says it's a single integrated framework. It covers all aspects. But the other one is it's a holistic approach. It takes on a holistic approach. Why? Because it has 7 enablers. It doesn't look at just policies and frameworks. It tells you, so this is another MCQ that they can ask you. It's the 7 enablers. It's looking at all this, not just having policies and procedures. It tells you must have a framework, you must have policies, you must have processes, you must have the proper structure, you must have the proper culture, you must have information, you must have the proper services, hardware, and software, you must have the proper people. So can you see it's a holistic framework? It looks at all 7. So the 7 enablers are related to principle 4, right? Then you have this concept of separating governance from management. It says, okay, here it's like this. Those who govern IT cannot be the same people as those who manage IT. Management of IT can be given to the respective departments. And it will come under the IT department. But the other departments and functions will also have certain responsibilities. The governance of IT will come under the board. These have to be separated. These have to be separated. So that concept must go into your head. That those in an organization, the governance in an IT governance and IT management to be treated as distinctive activity. They are separate. Governance is the responsibility of the board and IT management is the responsibility of management. right? Then they say governance looks at evaluate, direct, and monitor. Then management looks at plan, build, run, and monitor. That is that diagram that I showed you. I will show that diagram to you again because I don't want you to do diagrams. You can remember it a little better. Can you remember this diagram? Yeah. Governance is about evaluate, direct, and monitor. Management is about planning, it's IT budgeting, building. That means sometimes you build the software, sometimes you acquire it, run it. You have various sites of IT related services, and then management also must have a monitoring. Monitoring cannot be just done by the board. At management level, there has to be a monitoring in place. Evaluate, direct, monitor comes under governance. So if you look at this, you have the 5 principles, right? Stakeholder needs is one, end-to-end enterprise is another, single framework, holistic approach. This is where the 7 enablers come, and you have separating governance from management. Principles. Then you have the enablers. 7 enablers, right? That you will have to remember. Then you have the processes. One enable is the processes. So in this model, they have gone heavily into it and identified those processes also. The governance processes are identified as EDMs, right? 1, 2, 3, 4, 5. And others are identified under the management. So these processes must be there. This is more explained even more when you look at the standard framework. Here are the processes, structures, culture, ethics, behavior. All that in there, I will share this document with you, right? So don't worry. Then let me get back to presentation quickly. Few more things. Separating governance from management also, I hope you understand, and I hope you also understand that processes are also divided. Some processes come under governance, some processes come under management, right? Then you had when COVID-19 came, then now today you have COVID 2019. That's the last. That also they might test you. What is the last version of COVID? That's COVID 2019. Expands on COVID 5's key principles for the governance system applicable to IT governance. We include 6 governance system principles and 3 governance framework principles. The 6 principles for a governance system are summarized. Stakeholder value, holistic approach, right? Dynamic governance system, that means it cannot be static, it will constantly change. Governance distinct from management, tailored to enterprise needs, and end-to-end. So earlier, can you remember under COVID 5, we said there were 5 principles. COVID-19, when it came, they expanded it into 6. So stakeholder value was always there. Holistic approach was also there. Governance distinct from management was also there. Then you had end-to-end was also there. Now you have tailored to enterprise needs, right? Tailored, that means enterprise to enterprise, it changes. Let's go back. Yeah, single integrated framework is not there, right? Right. Instead of that, they have brought in, changed a little bit. A dynamic governance system. Dynamic, that means it changes. You can't have it changes over time. The governance system must be dynamic. You can have changes to people, processes, structures. You have to have a dynamic governance system. And the other point is that it has to be tailored to the enterprise. Right? If it's a big organization, the governance framework will be a little different. Framework is the same, but the adaptation or the implementation will vary based on the size and complexity of the organization. So 5 became 6. So now what you have to mainly remember is these 6. Stakeholder value, holistic approach. Holistics is always about those enablers, right? Then you have dynamic governance system. That means the governance system must be dynamic in dealing with the change. Changes to people, changes to infrastructure, changes to applications. And then governance must be distinct from management, which we already discussed, and tailored to enterprise needs. The governance system must be designed to meet an organization's requirements and end-to-end coverage. It's not solely related to the IT function, but it covers the entire organization. That means the IT goals are linked to enterprise goals. Earlier, IT goals were only the IT department's problem. Now it's not like that. IT goals help to achieve the organization's goals, right? Then the other one is there is a little bit of theoretical knowledge. The following are 3 principles for a governance framework. It is based on a conceptual model. True, it has to be open and flexible, and it must be aligned with major standards. So if you use COBIT, it has all these 3 features, right? An IT governance program has 2 separate pre-planning and program implementation. When you're going to implement a governance framework, obviously you have to plan it and then you have to implement it. You can give this at leisure. Right. Then you have 40 governance management objectives organized to 5 domains that I will share that with you. Now, the other important thing that you must know is, but anyway, just remember about the 7 enablers, the 6 principles, and what those 6 principles are, what those 7 enablers are, and learn and study a little bit about the enablers and the principles. That's what is important. I don't think they will go in depth into more into that. Now, the other part of this is that you have to know this model called the maturity model. The maturity levels. Right? What does CPM stand for? Orbit Performance Management Model measures performance using capability and maturity levels. The capability maturity model integration development version 2. That is important. Now let's just learn a little bit about that. And I will just tell you what you need to know. Now, in any organization, you look at the risk management processes. For any process, you have to look at the maturity levels. Now, COBIT also looks at the maturity levels, right? Maturity levels can be divided in various ways. So if you go to, for example, if you go to an organization and you find, right, in that organization, nothing has been defined, there are no SOPs or anything, right? Then it will be initial stage. Maturity is very initial. If there is some sort of practice that they have, there is a practice, but nothing is documented, then it's managed. If everything is nicely, beautifully documented, it's defined. Quantitative means there are KPIs and it's monitored also. Optimizing is the best level. So you have to know these 5 levels. Any can maturity levels of internal controls or of risk management, anything. You can measure it using these factors, right? So can you just go through what's on the screen? Because you have to know the levels: initial, managed, defined, and the best range is optimized. You don't know that. Because of the exam, you might be asked, right? Now I will share with you another document. Can you see this? These initial is level 1. Processes are unpredictable, poorly controlled and react. Manage means processes, there is a practice, there is something is happening there, they have some sort of practice. Define means nicely, everything is nicely defined and documented. Managed means processes are measured and controlled, it's all quantitative. You have KPIs, budgets are set, then you identify the actual, you identify the variance or the deviation, and then you take action to control it. And then you have the optimizing stage. So for the exam, what do you need to know? The 5 levels: initial, managed, define, quantitatively managed, and optimized. What is the best level? Optimizing. The worst, initial. And then if they ask you a question, you must be able to define it. The capability maturity model integration. It's called CMMI, capability maturity model integration. Was initially introduced by the CMMI Institute, and it's related to basically software development. Initially, Carnegie Mellon University, when they were developing software, they used this model for softwares. CMMI defines the following 5 maturity levels, 5 levels of maturity. 1 to 5, initial, managed, defined, quantitatively managed, and optimized. Now you have CMMI version 3. 2023 CMMI version 3. So there has been CMMI version 1, version 2, and version 3. Right now, we'll go into CMMI. Version 3 is also there, right? Give me a second. So what does CMMI stand for? You will have to know. Huh? Then what are the levels also you will have to know. That is also important. And another beautiful diagram, I'll show you that also. This one here. Initial, unpredictable and reactive. Work gets completed but is often delayed and over budget. Managed. Projects, prospects are planned, performed, measured, and controlled. Defined. Proactive, not reactive. Organization-wide standards provide guidance across projects, programs, and portfolios. There are systems. Right? There's a framework. Quantitatively managed, measured, and controlled. Organization is data-driven with quantitative performance improvement, objectives that are predictable. Optimizing, stable and flexible. Organization is focused on continuous improvement and is built to pivot. So we're talking about continuous improvement, it's optimizing. Initial, unpredictable and reactive. Things are happening. They're delayed and over budget. Managed means at project level, they are managed. Projects are planned, performed, project level. Defined means now they have for all projects, they have organization-wide standard. This is how things have to be done, irrespective of what the project is, program, portfolios. Proactive management is there, not reactive. Quantitatively managed means everything is measured, controlled, data-driven, right? Optimizing is now, at a different level. That's the best level. Talking about agility, innovation, continuous improvement. So it's a very useful diagram. CMI maturity level 3 is the defined level, right? I think this will enable you to. So again, CMMI version 3, just know about the 5 levels. I think that should suffice for exam. This we discussed. Well, IT is mainly about uh, getting the value out of IT investments. Now, as you know, if you look at the capital expenditure budgets of most organizations, they spend a lot of money on IT. So it's a huge investment. It's a huge investment. So let's say you're implementing an ERP system, or you're upgrading all your hardwares, or you're trying to get a new business application like an ERP. So are you getting the return on that? Right? Before you go, there's a business case telling you this is why you're implementing this ERP solution. This is why you're going to spend 300 million on getting the ERP. So you have to ensure that once you spend the money, the organization gets the value out of it. So at the exam, if they ask you what is the model that ensures that the business gets value from its investment, it's well IT, value IT model. It measures, monitors, and maximizes the realization of business value from investment. So if you are looking at a big investment, and best model to apply on top of COBIT is well IT model. Can you see the first point? Well IT is based on and complements COBIT. It's like a plugin. It's built on COBIT. Its main objective is to ensure that value is created, that the benefits envisioned before you try to invest in some IT project, that those benefits are realized, that you get the value from your investment. So it measures, monitors, maximizes the realization of benefits or value from IT investments. Now, the other point that you need to know of this model is the three domains. The three domains: value governance, investment management, and portfolio management. Right. This domain defines the relationship between IT and the organization, which includes those functions in the organization with governance. So value governance means, I suppose, the board at the end of the day is responsible for IT governance and oversight over governance, and to ensure that the organization is getting the maximum value from its IT investments. Investment management, this domain manages the organization's portfolio of IT related. So investment management is all the IT investments. It can be in infrastructure, it can be in applications, all those investments. And portfolio is the domain that maximizes the business case for investments. It's like a investment portfolio where you have invested in shares, you have invested in treasury bills, bonds, you have invested in fixed deposits, and you have to manage all this. So for examination purposes, oh, sorry. Sorry. So for exam purposes, well, I'll give you the points that they could ask you, right? One is, what does VAL IT stand for? Value IT. It is built on top of COBIT. That means the best IT governance framework is COBIT. On top of that, you have this VAL IT framework, complements COBIT. Second point is that if they ask you any question about getting the maximum value out of IT investments, ensuring that the benefits are realized from investments in IT, what is the model you should use? That will be the value IT model, value IT, VALUI IT model. How many domains does the value IT model have? Right? Then you have to say value IT model has 3 domains. three domains, right? Then the other point that you need to remember is the names of those three domains. So VAL IT stands for value from IT investments, value from IT investments. Let me just type that here. VAL IT stands for value from IT investments. You see from the name itself, you can figure out the basis, the importance of that model. Who introduced that model? IT Governance Institute from ISACA. ISACA has a small, what do you call, a division called IT Governance Institute. They introduced this framework. It is a framework for managing and optimizing the value of IT investments to get the maximum out of IT investments. It has three components. What are the three? Value governance. What are three components? Investment management and portfolio management. Those are the three components. I'm just giving you because the exam is not about this model, but you have to know a little bit about this model. I don't want you to get those MCQs wrong, you know. Anything else? Any questions that you have or that you want to ask me on this area? Any questions on this model? And the ESAC model is also there. But of course, I'm not going to go into detail of that. The following is a useful memory aid for ESAC model. These are the components. These are the ESAC model has 5 components. Availability, that means IT systems must be available. They must be capable. Functionality must be there. Protectability, we have to protect them, and the accountability. Right. So you can see there are a lot of overlapping areas. ESAC model. Right. Let me try and help you. What does ESAC stand for? What does ESAC stand for? Electronic Systems Assurance and Control. Electronic Systems Assurance and Control. This is what it stands for. What are their components? They say IT business objective. There are 5 objectives. That means if you have IT system, it must be available, it must be capable, it must be functional, it must be protected, it must be accountable. Otherwise, no point having all these systems, right? So available means it's very easy. Information, then processes and services must be available, of course, when needed. That's what availability is. So that includes, you know, system failures, malfunctions, inadequate capacity planning and all that. Capable means what? Capability means end-to-end reliable and timely completion of all transactions. When your systems are there to process things, and then end-to-end reliable and timely completion and fulfillment of all transactions. Right? Systems must be capable, must have adequate capacity, communications, and consistently meet the needs, I suppose, even at peak demands. Means system must be have the right capabilities, having the right system capacity, the communication, and consistently meet the needs. Functionality means what? System must provide the facilities, the functionality, ease of use, responsiveness to meet user needs. Functionality is very easy for you to remember. Means the system provides the facilities, the responsiveness, the ease of use to meet user needs, functionality. Protectability is what? Protection of the hardware, software, data from unauthorized access, use, harm, data security, data confidentiality, program security, physical security, so protection. Protection of hardware, protection of software, data from unauthorized harm, access, use. Accountability is what? Accountability means that in a system, roles must be properly defined, responsibilities must be defined. And you must be able to hold someone accountable if something goes wrong. So it's about the system identifying roles, actions, and responsibilities. You look at data, the ownership of data, the authentication, logical access controls, giving people access rights based on a need to know, need to do basis. So the assurance objectives would be achieving achievability, availability, capability, functionality, protectability, accountability. So that's all I want to tell you about the ESEC model. I don't want to tell you anything more. So just remember this, right? What ESEC stands for and the objectives of having a system. It must be available, capable, functional, protectable, and accountable. And what these mean, I'll send you a small note also on what these mean. Right? That is important. Then you have these guides to assessment of IT risks. Various guides you can go through it. I will try to send you a few on IT general controls. You can read it at leisure. What are soft controls? The COSO and COCO models emphasize soft controls. What are soft controls in IT? That's a culture. Soft controls are the culture, right? The communication of ethical values, the fostering of mutual trust are soft controls. In the COCO model, in the COSO model also, it's there as part of the control environment. Soft control should be distinguished from hard control, such as compliance with specific policies and procedures imposed upon employees from above. So just remember that the COSO model emphasizes the importance of soft controls as well as hard controls. Soft controls is what? Communication of, example, communication of ethical values and fostering of mutual trust are soft controls. You look at the COCO model, right? Go back. This purpose will give you the soft controls. I will send you a small note also on that. Because at the exam, they might ask you what are the 4 components. Or they might do something like this. What is the component which is not part of the COCO model? They will give you something like this. What is the component that is not part of the COCO model? Then it will be integrity. Commitment, capability, there are two C's. Purpose, two C's, and monitoring and learning. Police can catch many lawbreakers. Purpose, commitment, capability, monitoring and learning. So under these also, what are the factors covered? Let me just see whether I have the note. From the Coco model, I'll try to send you. So it's not very getting a little complicated and technical. It's not easy. You go through all these things only you realize when you come to the end. There are so many areas to cover. But I've given you the key points, how you could be tested. Don't go more than that. We don't want you to waste too much of your precious time on unnecessary stuff. Right. So do you have any questions that you would like to ask me? Have any questions, you can always ask me now. We have about 5 minutes left. All right. If you don't have any questions, we'll stop for today. Next week, we will start with the risk management framework. That is also very important. And I will share with you all the additional material that I showed you today. All right. Thank you. Good night.
Thank you. Good night.
Night. Good night.